Today, the long and the short of it. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. And I'm joined today by Damien Klassen from Nucleus Wealth. Hello, Damien.
Hi, Martin.
Great to have you with us, and thank you very much for spending some time. We're going to have a very interesting conversation today about the long-term and the short-term challenges, economically speaking, and what it means in terms of the investment context. But before we get into that, just would you like to introduce yourself and also talk a little bit about Nucleus Wealth?
Yeah, sure. Thanks, Martin. Yeah, look, my name is Damien Klassen. I'm the Chief Investment Officer at Nucleus Wealth. So basically what we do there is we're trying to tagging it next generation investments. So the idea is we've tried to use some of the latest structures and the latest setups and to try and give everyday investors a way to invest without having to worry about sort of legacy systems. So we've been through this Royal Commission, and a lot of the problems that arise from the Royal Commission are the fact that you're using sort of structures that were set up in the 1960s to deal with investments. And nowadays, it's much easier to be able to run through things through separately managed accounts, for example. So you can have professionally managed accounts, but you can actually let people tailor things to their own ethical preferences, or if people don't want Australian banks, or if they don't want exposure to Australian residential property, we let them actually screen that from their own portfolios.
Okay. So the interesting point there is, as you say, is it's perhaps harder these days because there are lots of different options, but trying to formulate the right structure for a particular investor is always going to be interesting. So I guess there's more flexibility.
Yeah, absolutely. And I sort of came from my history is I helped, a long sort of 20-something year history across different brokers and everything. I helped set up Aegis Equities Research, which was an independent research house. I spent 3 years at Schroders in their international quantitative fund. And one of the things I really noticed there was, there's certain structures when somebody turns up with $200 million and says this is what they want in a structure because they know what best of breed is. Well, 20 years ago, you couldn't have supplied that to ordinary people, but nowadays you can give that to somebody with 20 or 30,000. You can give sort of a very similar structure and get a very similar outcome.
Okay, well, very interesting. And so I know that you are a very avid studier of all the data around the place, and you've put together a very interesting pack of slides, which we're going to discuss. I should just say there is going to be obviously the standard warning and disclaimers, which we will show around. This is just general advice. It's just conversations around what's going on. But nevertheless, I think there were some really important long-term thematics that people need to understand.
Yeah, absolutely. I'm sort of trying to do, and we've obviously got 45 minutes or so to run through this, but I'm trying to cover the entire world and the entire back history, and so it's going to be a pretty quick fly through. And a lot of these issues, we go into more depth at a different time. And you and I went through last week, the housing, some of the housing side, and we've published a lot of stuff on the individual, but this is sort of trying to give you the 20,000 foot view of how we're seeing investments and what we're doing for our clients.
Yeah, I think that's important because sometimes I think people can get sort of down into the weeds, as it were, but it's sometimes really important to stand back and just think about, well, what is the long-term trajectory of what's going on and how does that inform the decisions? So let's start with some of the long-term trends then that you've been looking at, because I think that's a really good place to start.
Yeah, absolutely. And so these long-term trends, these aren't something you're going to rush out and buy or sell stocks on tomorrow. These are things that are going to sit there and just chip away gradually at the economy day after day after day, just tiny little effects. And what will happen is recessions will happen or booms will happen and the trend will disappear. But then we come out the other end of the recession or the boom, and then you'll notice, hey, that trend's still been in place. It was just hidden by the shorter term news. And so the first one is this rising inequality. Now this is, there's obviously gets a lot of airplay out there, but the last 40 odd years have been fantastic if you're in the top 1%, and not so good in the bottom 50%. I've got a chart up there showing now. A lot of these charts have picked the US just because the data is a lot better, but it does follow through a lot of other countries. Europe, Japan, Australia, most developed countries tend to show the same indication. And what we've seen there is that the bottom 50% of people sort of fallen from having about 20% of income down to sort of about 12% of income over that sort of late 70s through to today. And the reverse has happened for the top 1%, where just more and more money is flowing through. And so what that means, there's some people say whether there's good things or bad things about that, but I think the key thing economically is that what that means is if you give Gina Reinhart, for example, another $1,000, she's not going to rush out and spend it. She's going to throw it on the pile. If I give somebody sitting in the street, with a sign out front, another $1,000, well, that's gone 20 minutes later. So the idea is that the more inequality you get, the less demand. And that's what we're very much seeing. Governments right around the world are struggling with this idea of we just don't have the demand coming through, and which is why everyone's pushing interest rates to lows, and there's discussion about fiscal policy and everything like that. But we've got this one trend is sort of throwing through, and we're not really seeing any signs of this reversing. If anything, we're actually seeing signs of this increasing.
Yeah, and it's interesting that chart shows that the swing towards the more affluent was way before the GFC, right? This is a long-term trend, but it's also true that the GFC, the quantitative easing, the low interest rates has exacerbated it even more. So essentially all of these central bank strategies are putting more wealth in the 1%. And as you say, it's taking it away from those who are more likely to spend.
Exactly. And this is actually, this chart is an income chart. There's the same one which you get for a wealth chart. And the wealth chart is more extreme in the last few years because that's, as you said, quantitative easing, pushing interest rates to zero, hasn't affected incomes as much as it's affected wealth. And so, there's sort of two sides to that coin. And there are lots of other ways you can split it. I think this is one of those charts where people will wheel it out and look at the last few years and go, oh, it's pretty stable. Things aren't getting worse because it's the wealth side's been getting worse over the last few years, and then it'll flip back around. So but I guess the bottom line is whether you think this is a good thing or a bad thing. I think the most important thing is it's not looking like it's changing. And we had this whole 1% issues and following the financial crisis, but then they faded away. And so until we actually see some meaningful change, this is one trend which we see just continuing on.
Okay, and then let's just sort of take to the next conversation point, which is the boomers, right? Because the other point there is that boomers were in the fortunate position of riding the wealth cycle and income cycle quite well over the last 20, 30 years, but that's beginning to change now.
Yeah, so this one I'm probably more interested on this front. There's obviously they've I think a certain age group has certainly benefited from that. But I guess the main one I'm focused on in my next chart is the idea of what's called a dependency ratio. And so what that means is the more people we have out there that are working, the better it is for everyone else because the people who are being supported, either old people or young people, are being supported by more and more workers. And that's the last 30, 40 years, we've seen this fall as the baby boomers were born, this huge contingent, and we've got this big hump on the left of that graph. And then as time goes on, it just gets falls away, so that the number of young people, and then now we're hitting that stage where the older people are just starting to rise. And we're sort of sitting just at the start of this curve. And so year after year after year, it's going to be harder now. There's going to be fewer and fewer workers every year. And we're in this quite a steep part at the moment where a lot of baby boomers retiring, which makes it harder for the rest of the economy. You just need fewer people supporting more people. And it's Japan's. So again, I've shown the US here. Australia's a little bit better. Japan's a lot worse. Europe's a lot worse. And so, and quite interestingly, China is actually just hitting the stage as well. So China's had the one-child policy, and that's puts them in a very bad place on this graph as well. They've had the benefit of fewer and fewer children over the last sort of 20 odd years. But now they're hitting to the stage, they call it the six pocket theory. You've had grandparents on both sides and a parent on both sides supporting one child. And now it's about to go in reverse. You've got one child who's got to support four sets of grandparents and two sets of parents in their retirement. So it's a positive, it's been a great positive, but this one's flipping around. So we can see changes happening now on this one.
And I guess you could argue that in Australia, one of the reasons why we're a little bit better than some other countries is because migration has been so high here. And so essentially we've seen a lot of younger people sucked into Australia through the migration programs, and that's insulated us a little bit. But nevertheless, the same things are still happening.
Absolutely. The same trend is, we're still, we've had a tailwind, and if the best you can say is it's not quite, the headwind isn't as stiff in Australia as what it is elsewhere, but it's still certainly a headwind right around the world. And that's a very similar trend to the next ones I've got on there, which is the female participation. I've got the chart on the left is probably overstates things a little bit, because some of this is actually what we just saw, that older people and younger people. But it's very clear that women have gone from being quite a small part of the workforce to quite a large part of the workforce. And again, you just get that natural improvement in an economy as people, more and more employees, go from being not working to working. But again, this is another one that's slowed. At the top of the right-hand graph, I've got some of the Scandinavian countries where it's basically flattened out, and that it looks like it's not rising anymore. Also in the US has been a slightly a lower level, sort of 46, 47%, but again, it's flattened off and looks like that's falling away. So, and I guess there are these, there is some reasons for people to think that in terms of child rearing, women do tend to take the front, I guess most of the core activities there, and that there is a preference. So I guess the argument is at a certain stage of income, there's a preference for women to say, well, you know what, you might pay me 10% more or 20% more, but I'd actually prefer just to work 3 days a week or 4 days a week and spend some time in sort of doing child rearing. So yeah, so female participation, again, it's been this great tailwind for the last 30, 40 years. It probably turned a few years ago, but in a lot of countries. But again, it's not going to be a tailwind, and might even be a slight headwind in some countries as improved conditions mean women opt to work a little bit less.
An interesting. Guy DeBell spoke about this last week in his presentation on wages and employment in Australia, and he was highlighting the female participation. But he also suggested that perhaps it's also to do with the higher debt levels. In other words, you need two incomes to be able to get a mortgage here, to be able to buy a property, because property prices are so high. And he also spoke about some of the other pressures on income growth and the fact that because of that, just households needed more income, therefore more females were actually working.
Yeah, and so that's not the case you want, is it? It's not. You don't want to say, yes, we've got debt slaves, and so we've had to drag women into the situation as well. And in theory, our economy is meant to be improving a lot for everyone, and part of this is probably that inequality issues. But yeah, it is certainly something you need to take into account for the investment outlook as we're sort of starting to put together this big picture.
Okay, and then the other thing, of course, is debt, because debt is at the heart of it. Unless you are the Reserve Bank and don't think that debt's important.
Don't think yeah, that's right. And look, I think we could probably get drawn into this one for you've obviously done a lot of stuff on this. I've done a lot of stuff as well. I think the key thing is private debt has increased dramatically. Australia sits particularly high internationally. Most of that's in housing, and so that starts limiting what people can do. So, and as you said, it starts dragging in when people have to start dragging in their wives to work as well, just to be able to afford a mortgage to live in an area that they want. You start to. It's great for a certain part, and I actually think this comes back a lot to the inequality. So inequality, rising inequality can be hidden if you let people borrow. So if people want to live a certain lifestyle, they go, yes, I deserve to have a car, I deserve to have a house, I deserve to have my children educated. And if that was the case in the 70s and 80s, that you could do that with a moderate income and not have to increase. But over time, it got harder and harder and harder as the inequality grew. But if you let people gear up and borrow more money, and at the same time interest rates fell, then to the average person, they didn't really notice, because they got what they wanted. They still had their house and their car and the kids educated. It's just that came now at the cost of having a huge amount of debt. At a certain stage, that runs out. Now we don't know when that is. I'd hazard a guess we're getting pretty close. Once you start getting interest rates down at zero, that pretty much shows you can't keep lowering the interest rate to let people do that. Now you've got to rely on wages growth, and wages growth is very, very low. And Australia's sort of got its problem is that with so much immigration, which helps some of those other trends, as you said, but it also penalises wages growth, because you keep bringing in more immigrants, which keeps wages down. So yeah, so rising debt is one more, been a great tailwind for the economy, but I think at best you'd say that it's turning neutral, and you'd have to think at some stage it turns into a headwind.
Certainly the data from last Friday showed that the 3% annualised credit growth for let's say, the housing sector, is as low as it's ever been.
Yeah, well, and I guess that's coming back to the stats. They're about 50 odd years worth of stats I think we've got in those ones. You'd like to think, I think I've got one in this later on, that's the part about saying, well, in aggregate, debt can only grow as fast as incomes in the long term. For 20, 30 years, you can do that, but eventually your debt has to reach a level where it has to grow in front. And if you want to start paying it off, debt has to actually grow slower than incomes. And so, even 3% is above, as you mentioned before, is above some of the wage growth you're getting. So, debt's still increasing if you can't get it below wage growth.
And I guess the other factor long term is the whole question of rising trade or what's happening around trade, right? Because it's supported a lot economically internationally, but there are also some headwinds there too as well.
Yeah, that's right. So rising trade's been another great 50-year increase and it's the great benefit of trade. I'm a huge believer. You get two people come together and they exchange goods and both walk away thinking they've got a better deal. There's all these benefits you have from scale in terms of one person doing lots of everything in their country and benefiting from scale and the other person building something else in their own. And so it's been great for the world economy. But as every sort of Donald Trump headline reminds us, that's the old era, and potentially, he is right in a number of ways about saying that has brought about more inequality, especially in the lower end of developed countries. So it's been great for developing countries. That's actually improved inequality. It's been great for the 1% because they're the ones profiting. Where it's been bad is the rest of the people. And so that's where I guess Donald Trump's got a lot of his votes from is that disenfranchised voter. And so, there is a point that trade has been this great tailwind for the economy and it's turned into a headwind. Even if we get another something come out, and I'll go into a little bit more detail later on our thoughts on trade, but certainly no longer a tailwind for the world economy. The other one as well was taxes. That was in there. So this is and I'm using this because I'm doing this from an investment perspective. I just want to talk about corporate taxes. So corporate taxes in the early 80s, sort of as a combined corporate tax around the world was about 50%. Now we're under 25%. So we've halved the taxes over that time period. And again, this is a trick you can only play once. We can keep going from where we are, but you can't keep playing this trick. And if you look just simplistically at company earnings growth, over sort of the last 30 odd years, rough back of the envelope, you're doing about 6% nominal growth. About half of that's been inflation. So you've got about 3 and a bit percent of actual sort of real growth. And of that, over 1%, but I think about 1.3 of that's come from tax cuts. So I guess as of the real growth we've seen, a significant proportion, probably about a third of it, has been tax cuts, which is great from a company's perspective. You see your earnings grow and everything like that. But there's only so many times you can play this trick. Having said that, this is another trend that doesn't look like changing at the moment. We've just seen Trump put through his tax cuts. Everyone else is talking about, we have our government keeps coming back to saying, well, we need to lower tax rates for corporates. It happens in the UK as well. So I think this trend's going to keep on going. But again, there's a limit to this. And obviously going from 50% tax rate to 25% tax rate is a lot better for companies in terms of how much earnings growth you get than going from 25 to say 15% growth rate.
And it's worth saying, of course, that what that has happened as a result of that is that the proportion of the total tax take has shifted more and more to households.
Absolutely.
And away from companies. So in other words, if you look at today, the mix of income is much more from income tax from households relative to corporates.
Yes, and comes back to that inequality that we were talking about before. Yep. One more reason why, as I said, the trends for inequality are likely to keep on travelling.
Now, the other one you've highlighted, which I hadn't really sort of thought about much, is energy costs. And I think that's quite a significant issue.
Absolutely. Now, this one is one which has had very little, it affects things over time. But I guess what I wanted to really highlight was the effect of solar. And I've got a graph here, a fantastic graph from Bernstein, which is sort of showing the price of solar over, a 50, 80 year period or whatever it is. And the whole idea is that solar and wind are on what we call a technology curve. So every time you produce another watt, it gets slightly more efficient. We get better at doing it. We can fit more onto a board. You produce more, so your unit costs come down. So the price is falling year after year. On the other hand, commodities are on a scarcity curve. So the more we consume, the deeper we have to dig to get the next one, the more it's going to cost. There are some savings in terms of better equipment and more automation, but they actually tend to get eaten up in terms of we just have to dig so much deeper, and it's so much harder to get what we're looking for. So then I've sort of said, okay, there's a big picture on the left. On the right, I've zoomed into where we are today. And the issue for this is we're at this point where the curves have met. And so there's this bubble now in terms of saying during the day, if you're looking to produce energy, then the cheapest possible way to do it is solar. Far in advance of nuclear, and better than coal and gas as well, in particular conditions, depending upon where we are and how you can do it. But it keeps falling year after year. The big issue is, though, as everyone says, the sun doesn't shine at night and the wind doesn't always blow. So you need your killer app. Your killer app is you add a battery to it. Now, batteries, that then makes it much more expensive. But batteries are on this same technology curve. Every year they keep falling. And the other big benefit of batteries is we've got three different groups all trying to get cheaper batteries. Everyone walks around with a smartphone in their pocket, and they want more battery life on it. So you've got a big group of smart people trying to get the batteries, more efficient, cheaper, and everything like that. You've got cars, so Tesla and all the electronic vehicles are all out there trying to get better quality batteries and cheaper. And then we've got people running houses and utilities trying to store this energy. Now, each of the batteries is slightly different, but they all benefit from research that they're all doing. And so it's this other thing where the battery cost is on this same technology curve. It's actually falling about 20% per annum. And so the thing with solar's fallen so far now that the key determinant is actually the batteries, as to whether we'll hit this point where it gets to be as cheap to stick in batteries plus solar as what it is to run other energy. So I've got a table that I wanted to put up, just sort of showing where everything sits. And on this table, I've put in different levels. So I've got where gas sits at various costs. So gas, $3 per MMBTU is roughly the US cost of gas, whereas $9 is the Australian cost, which makes a huge difference. Coal then sort of sits, in levels depending upon, usually if you're right next to a coal, and you can just pour it straight into your, straight from the mine into your power plant. That's a lot better than if you have to ship it all the way, say, to China from Australia. But it's less sensitive. The key thing from this is wind and solar are cheaper. Adding a battery makes it more expensive, and so it's not a no-brainer at the moment to switch. And so when people stand up and say, it just doesn't work, they're right. It just doesn't work right now. But it's getting really, really close, and the costs keep falling at 20% per annum. You don't need to go very far into the future before it does work, and it does work significantly. And so I take that line of solar plus a battery as being the upper limit where commodity prices just can't go past it. Because if the coal price went back to sort of $200, well, all of a sudden now solar plus battery is the cheapest place to get energy. So why would you bother with coal when you can do it cheaper at this this point? And so then if you jump forward and just say, well, let's just roll that forward, and table up which just says, well, let's just use, rather than a 20% per annum we've seen, let's say it gets a bit harder, let's just use 10% per annum and go for 5 years. Well, now they're in the mix and they're better than coal. And so we're about to go through this transition phase, and these transitions are going to be difficult. It's really hard for companies, and it's really hard for governments in the area who have big investments in this. And so you're going to see companies, you're going to see governments, you're going to see consumers, all trying to fight with each other to see who loses out of this. Now, the history says that the consumer usually is the one that loses. Hopefully, we'll start seeing, the lobbyists not get the upper hand as much in this case. But it's a relentless, and I guess a good example for me is something like an Uber or these cars where it's a relentless change where it's going to be cheaper to do it the new way. The vested interests will fight as much as they can, and they'll drag it out and delay things. But eventually, if it's a good idea and it's cheaper for everyone, the cheapness will overcome. And so we're almost at that point, I guess, is the key thing. So we need to be watching those energy costs. And just sort of paying attention to where that sits, and it's quite easy to pick losers in that sector. The winners are a little bit harder. So, but that's one of our other big trends, which has actually been hardly affecting people at all for the last 20 or 30 years. But we're actually just about to hit the stage where it is going to be a major impact.
And the chances are, presumably, that once that point of pricing differential switches the other way, then it's likely that there will be significant swings quite quickly.
Absolutely, yeah. These things show that even I want to look at the cars as well, but even the people going from horses to cars, most of the transfer happened over about a 10-year period. Like, it's surprisingly fast how these things happen, and that was 100 years ago. And so we look forward to the days of people with sitting on their Nokia phones, looking at these smartphones, going, no, why would I spend 7 times as much as what my phone cost me to get a smartphone? And 3 years later, everyone's got one. And so these things do tend to happen quite quickly, and those energy costs, that also affects your car as well. So the same factor, the cars are a little bit further behind, but I tend to like to look at things on either on a commercial basis, so driving about 100,000 K a year, or a personal basis, driving about 15,000 K a year. On a personal basis, we're miles away. We're probably 5, at least maybe 10 years away. On a commercial basis, it's there. So the cost to run an electric vehicle on a commercial basis, if you're going to travel 100,000 K plus a year, it's basically at parity now and falling. And so that's where driverless technology in particular has got one. I could spend a whole podcast on that, but if that comes. When that comes, and who knows, that's another hard one. Is it 5 years? Is it 10 years? Is it 15 years? That's going to have a huge difference on a whole bunch of different factors, and particularly electric cars, because an electric driverless car is far cheaper than an electric petrol-powered car. And so, yeah, again, a huge difference, and that will make a huge difference to people's budgets. You're not having to have a second car, or not having to have a first car in some cases, not needing garages all of a sudden opens up more space, parking spots in the city. Like, in terms of, there's a whole bunch of different things. Like, there'll be people can live further away and sit in these things and travel. There's a whole range of different factors. We're not quite there yet. It's a little bit further behind the electricity, but it is a trend that's just inexorably moving closer and closer. And again, just need to keep that in mind as our overview. So that's sort of our 7 big long-term trends, and they're the ones that we're sort of expecting to come, just keep chipping away. And then we move into sort of the more boom-bust trends, which are the mid-term trends.
Yeah, great. And I think that if you think of those long-term trends as, if you like, the undercurrents, right? Then you've got these slightly shorter term trends sitting over the top, which perhaps interfere with some of the longer ones too, but actually probably have more significant impact more quickly.
Absolutely. So this is our, if you're talking about oceans, for example, we've got our rising sea levels, and these are these long-term trends, is our rising sea levels coming up. These mid-term trends are then sort of the tide moving in and out on a day-to-day basis, and then your short ones are the waves actually coming in. So sort of 3 phases of how you're looking at things. But that rising sea level is just inexorable year after year after year, as it comes up or falls away.
Right, and you've called out corporate debt as the one of the most critical midterm.
One of the critical ones,
yeah.
Yeah. So corporate debt tends to, and I've grabbed one of the charts from David Rosenberg runs a lot on this, and he's just sort of picking out the credit cycle peaks, and they pretty much time along with the recessions. So what you do is you get this big build up in corporate debt, and then companies start falling over, banks going bust, whatever the case is, and then that drops away dramatically, and you end up with a recession, and then you start the whole process again. And it's a relatively forecastable sort of process, and knowing exactly when the peak's going to be, though, is difficult. You never know within a few years, but you know when you're getting close. And this is another one where corporate debt is getting close. We're back to, or above, I think slightly above the previous cycles. Could drag on for another 3 or 4 years, could drag on for another 10 years, but it's more likely that we're not going to get too much higher than where we are today, and there's enough sort of dry tinder there that when the spark happens, it goes up in flames.
And it's interesting that the central bank in France, the central bank in Germany, and in the Fed in the US have all been warning now about this build-up in corporate debt and the fact that it probably isn't sustainable at its current levels.
Yeah, and absolutely. And at the same time, central banks are lowering interest rates, trying to get companies to borrow.
No,
so
go figure.
Yeah, that's right. It's sort of hard to, as a company that's sitting there going, did you want me to borrow or not borrow? You got the central bank turning around saying, let me lower interest rates for you. And you got the guys on the other side saying, look out, there's risks here.
And of course, a lot of that debt was actually to fund corporate buybacks, right? So basically, they bought back shares to lift the share price, but that's not an economic investment in the future of the business. That's just manipulating the share price.
Yes, in a way. I have a little bit more sympathy in that there's lots of ways companies can increase their debt, and one of the ways they often do it is they go out and buy something at a silly price from someone else. I sort of feel as if they're buying something at a silly price from their own shareholders, I sort of feel as if that's that's not as bad as them going out and buying something at a silly price from different person's shareholders. So you're right, though. The net effect is, I guess in the end, the companies want to gear up. They're going, we're sitting here without enough debt. We'd like to gear up because we can borrow at such low rates. How they get there, whether they do it through a buyback, whether they do it through capital returns, whether they do it through buying other companies, doesn't really matter in the end to me. It's more about the net effect, though, as you said, is we've got this elevated level, and it means there's a risk out there.
And what about Chinese investment? Because I guess that's another midterm cycle, isn't it?
Yeah, absolutely. Now this one, the issue with Chinese investment is it's way above what we've seen in any other country. I've got a chart up sort of showing that countries that ran a very similar development model to them, so Japan and South Korea in particular, the idea is you repress your local interest rates, which is to the detriment of your local savers, but you get them then. That means that your companies can then borrow at cheaper rates. So I've got a couple of different groups in the economy. One is consumers. I make sure that they can't save their money, or when they do save their money, they get low rates, which means my corporates can now borrow, and then they can go out and do investment, and that's sort of what they encourage. And that investment is at the start of the process is great for these countries because they don't have enough investment. They start building new roads, new bridges, new airports, all this infrastructure, new factories. Great for the economy, but eventually you hit this stage where too much investment, and you need to actually shift back to a more reasonable economy where you've got your consumers consuming and your businesses sort of growing at reasonable levels. Now, China's managed to go higher and longer than anyone has ever done before. So they're sort of been, I guess in 2011 they came out and said they were unbalanced and they needed to change away from this model. And in the meantime, they pretty much haven't done any sort of movement away from that. The financial crisis was great for Australia because China spent all this money on building new bridges and roads, and they needed all this extra steel, which sort of really saved the Australian economy. It wasn't as good for China in that they wasted a lot of this money on building. Your first bridge is very useful. Your second bridge sort of clears away some of the traffic from the first one, and your third one, by the time you're up to your seventh and eighth bridge, it's pretty hard to tell what's going on and whether you are actually getting any economic. And that's sort of at the stage that they're at, where they just have vast amounts of infrastructure that aren't being used. There's some of the sort of poorest states that have these bridges that are higher than any other bridge. Out of the top 20 bridges in the world, I think in terms of height, I think there's something like 16 or 17 in them within China, and they're in, a lot of them are through these sort of dirt poor sort of rice fields and things like that, where you don't really need that type of infrastructure. So Chinese investment has been great for the Australian economy, but it's reaching the end of its focus as well. And I've got another chart in there that sort of shows the amount of floor space under construction. And the issue with China is that as things start to slow down there, it's already growing everything as fast as it can, so it just tries to throw more money into the construction sector. And I use an analogy. It's a little bit like the Soviet Union when they were in this arms race with the US, and the economy itself was going so poorly, but they kept throwing more and more money into the military sector and more money, and eventually the whole thing collapsed under its own weight, is because it was useless spending. The Chinese spending is a little bit better in that it is sort of houses and construction and infrastructure. But again, once people have places to live, knocking down a bunch of apartments and putting up another set of apartments that are very similar is productive. So a lot of the building that they're doing, they're not growing in terms of population. They have seen a lot of people moving into cities, but there's actually fewer people moving into cities nowadays than what there were 5 years ago. So they do need to, in theory, they should be doing less building. They're actually doing way more building now than they've ever done before. And a lot of it's starting to turn into knocking old buildings down to put new buildings up, which is a little bit like the Keynesian, digging holes to refill them again. It's not a good use of an economy, of productive resources. And so there's only so much you can do that. And because it's all been debt fueled again, keep coming back to that debt, it makes it even worse. If you're knocking down a building where the debt hasn't been paid off, just to put up a new building that you can sell for a little bit more, and just to keep the people working. So again, a shorter term theme, a cycle that's gone on far longer than I would have thought, but it is reaching its end, and you are hitting the point where you do need it. At some stage it will come unstuck. And and where that is and when that is, it's hard to know. But the next downturn is very likely to capture some of that. And we are seeing a lot of Chinese banks right now starting to go broke.
Yeah, we've had 5 rescued in the last few months, right? Through various ways. They're also reducing the amount of capital that banks have to hold in China to try and prop up the system. And of course, the critical point to make is that Australia is very trade exposed to China. So if they do come off the boil, that's going to have a big impact.
Absolutely. I talk about Australia having sort of, 3 different legs to the economy. One of them is the resources side. The other one's the housing side, and then we've got everything else, and everything else is getting smaller and smaller. So if we're looking at the housing market not going particularly well, and we've got potential problems in China, then and China's already building a record number of houses. I mean, on that chart, the most interesting thing for me is they're annualizing about 1 million. A floor space about 1 million more this year than what they built last year. Now that increase is bigger than they've done before. So in 2011, at half the building rate, they came out and said, this is unsustainable, we can't keep doing this, we need to change. And they haven't changed, and they're doing double. And part of that is, a lot of it is the vested interests. It's very hard for people that have made so much money from this whole construction and building sector. They're the politicians and helping to fund them. If things start to slow down, they're the loudest ones squealing, and they're the ones sort of paying the money. So it's very hard for the economies to transition away from it. What tends to happen in other economies is they don't transition; they just keep going and pushing harder and harder until eventually you get a crisis and the whole thing falls apart. China at least has recognised it, but they're moving in the wrong direction still.
And talking about vested interests, I guess the Australian credit growth trends are also another set of vested interests.
Absolutely. Yes. So, as we spoke about the housing market, and I think the housing politico complex, as some have termed it, that, you need to, we've got a Prime Minister now that's sort of from the Property Council, and the important thing is to hold prices high, I suppose, for them. And so a lot of that's come from that lending growth. I've got one chart just sort of showing that, as what we spoke about earlier, just at cyclical lows. I actually want to jump to the second one, which is showing the Australian credit growth. And what I've used here is housing credit growth minus the growth in hours worked minus wages growth. And this is the one where in the long term, you'd expect that to be zero. And so we're sort of running at, decades of not being below zero. So to sort of even that chart out, so to speak, is that you'd expect that to spend a little while under zero, and just to sort of bring the credit back. And so you might think credit conditions are bad right now, but we're not rebalancing where we are, or any rebalancing is very, very slight. So if any of those trends are going to reverse, you're going to need one of those to grow faster. You need the housing credit, to grow slower, and either the hours worked or the wages growth to really pick up. And unfortunately, hours worked, I think we're pretty much at limits. You can, as you said, you can drag your wife in and try and get her to work as well, and drag your kids and send them out to work. But we're at a limit there, and wage growth, we're just not seeing any wage growth. So that sort of very much limits that whole equation. And so we're sort of, each of these trends, as you can see, each of the mid-term cycles are sort of leaving us more precariously positioned. So they're all sort of sitting at the stage where they're saying there are issues out there. They haven't really sort of hit just yet, but they are certainly lurking. And there's as I said before, there's a lot of dry tinder around, sort of waiting for a spark.
Right, and now let's talk about the waves, which is that third view, which is the very short-term issues, the ones which probably could bite us on the bum even more quickly. Yeah,
so the first one is central banks. Now, central banks have been trying to pump the economy with extra money, and they've pushed rates all the way down to zero. And I've got a chart sort of showing some of the major central banks out there. Now the Australian Central Bank hasn't been involved in this yet, but we've seen that the US tried to withdraw liquidity, and we had this huge fall at the start of the year, and then they've reversed course, and now they're actually pumping more liquidity into it. The Japanese central bank is up there with way more than the US, even with a much larger economy. They're out there buying exchange traded funds on the stock market. They're out there buying some corporate debt as well, because they're running out of government debt. So and then you've got the European Central Bank, which is sort of in a very similar position, and the People's Bank of China. And so they're all trying over the last year or two to start working their way off and failing. And now they're generally starting to turn back up again, the US in particular, and the others are talking about what they can do. So I think they've pretty comprehensively shown what they're doing right now doesn't work. And it works at averting disaster, but it certainly doesn't work at bringing us to a recovery. So watching the central banks and what they're up to is what's going to affect some of these shorter term waves in terms of whether we're seeing markets moving up and down. As they try to withdraw, we notice that the economies all start, we're suckling at the teat of the banks, and they all start dropping away and falling away, and the economy slows down. And we see some more liquidity come back in, and the markets also move back up again. It's affecting us, sort of trying to prevent disaster, but certainly not getting us out of the current problems.
And I've had a theory for some time is that they possibly are protecting the financial system, but actually the real economies and real households and real businesses in most of these countries, they're not seeing the benefit.
Absolutely, and it comes back to that top 1% seeing it, because their financial assets are going up, but we're not getting that demand. They keep talking about, where's all the demand, and why aren't we getting stronger demand, and why aren't we getting stronger wage growth, and at the same time, greater inequality and bringing more workers in to work at cheaper rates, and wondering why it doesn't all fit together.
Yeah.
So, yeah.
And then we've got the political landscape and those big waves too. And I guess the US-China trade deal has to be on the list, right?
Yeah, absolutely. So I'll skip it relatively quickly over these, just in the interest of time, because again, we could waste another whole podcast on each of these individually. Yep. But the big ones for me is the China-US trade deal. Now, just to put this in context as well, so Trump's been raising taxes and raising tariffs on the Chinese economy to try and force their hand. And they spoke about getting to a deal. They realized it was all too hard, so they thought, let's do a smaller deal first, which has just got all the easy stuff in it. And they've been at this smaller deal for, feels like about 6 months now. Maybe it's only 3 or 4 months, and maybe we'll get something signed. And markets are treating this as a huge positive. This isn't a deal. This is just a few things. You'll buy some stuff from me. I won't penalise you as badly, and then let's get on to actually trying to talk about the real deal. So at the same time, we've had Hong Kong pop up, and obviously a lot of issues there, really showing that clash of cultures between a command economy that wants to dictate everything and the free market. And at the same time, we've seen a host of other articles come out, whether it's talking about Chinese hacking, Chinese influence in Australian Parliament and other places, and so there's a steady stream of information coming out that's really showing that China managed to get itself into a unique position. Like, they're a very different political economy to the rest of the world. Someone in the US or a company in Australia would never consider outsourcing a whole bunch of its production to Russia, for example, or to North Korea. It's just something it wouldn't be part of their whole ethos. Somehow China managed to get itself in that position, and now we're starting to see where it's starting to really blow up and show those classic cultures. And so my view is that regardless of if you saw a deal signed tomorrow, that's not going to affect the vast majority of large companies who are looking to move their supply chains out of China, who have recognized the political risk and seeing people locked up and protesters in Hong Kong and all these, and they're moving their supply chain from China. They'll still use it wherever they can for cheap goods. And developed countries have always dealt with poor political countries for commodities and other sort of very base level products. But what they don't do is they don't let the next level, the next wave of intelligent products and smartphone, the actual engineering side of it and the sort of value add part. They don't sort of they don't generally get their supply chain into dictatorships and countries like that. And so what I think we're going to see over the next number of years is the unraveling of that whole Chinese. They want to take it to the next step. I don't think they're going to be allowed to take it to the next step unless they have a significant political upheaval. And so seems like a short-term positive news. You're getting a trade deal, but again, the deal that's looking like it's going to happen is not the trade deal that we were talking about a year ago. And I think the cat's out of the bag anyway on the whole industrial side of China is they won't be growing into that next set. Hong Kong, and then we've got Brexit as well, which is one more risk. So
continuing vagaries, yeah. So how does this then translate in terms of earnings versus valuations in the short term? How are you seeing that?
Yeah, so valuations. A big thing for valuations is we're sitting at quite high valuations. So the US market, for example, about 18 times its earnings. So what we're doing here is just comparing the price of the market compared to how much earnings there are. Generally, over the longer term, you might be sort of 14, 15 times. So we're sort of about 30% higher than that. One of the things I've got a chart up just to note, though, that usually what happens is when the market gets quite high in terms of its valuation, isn't necessarily a sign you have to sell. Usually it's a sign there's actually just about to be a wave of earnings growth. And so we saw that in sort of 2003, we were just about to have this huge housing boom and a debt boom, right around the world. So markets they looked like they were really expensive, but if you had it bought then, you would have actually made sort of 20-odd%. Meanwhile, earnings were up 30 or 40%, which made the price you bought that look much cheaper. Same thing again happened in 2009 as we came out of the crisis. Earnings, you could pay 20 times earnings so 16, 17 times earnings, which was much higher than what you could have bought it a few months before, but earnings boomed as they returned to trend. We saw the same thing again in 2017 when Trump got elected. So all tax cuts. So markets ran up in front of the tax cuts. We got all these tax cuts. We got our sort of 20% earnings growth. And now we're looking back at this same market saying, well, what's this market telling us? Now we've hit these same valuation highs. I'm really struggling to see where the earnings growth is coming from. In each of those cases, you could see the first two cases were recoveries. The third case was a big tax cut. You could see the earnings quite clearly. So now what I'm looking at is earnings which is very low and hard to see how it's going to improve versus valuations that are actually sitting at quite extreme levels. And this is, again, a global problem. I've used the US because there's a much better correlation between the two. You don't have to go very far to find cases where this didn't work, though. If I extended this chart back another 5 years, you would have been in the tech boom. And that is where we saw valuations run way in front and the earnings didn't come through. And so markets sort of fell quite dramatically. And so we're more, more in that latter camp. It's certainly not as extreme and earnings won't be as bad, but certainly in that latter camp of valuations look very stretched compared to earnings.
Right. And so you could say we've got low interest rates, we've got low inflation, low investment returns and probably a lower Australian dollar. So that actually really sharpens your thoughts in terms of what investment strategies to follow.
Absolutely. So that's sort of the overall picture. So now he's saying, well, what do I do with my money? And that's one of the things we find a lot of people coming to us who've said, look, I've been watching the Martin North podcasts or reading the bear stories, and they're sitting there going, great, so I put all my money into term deposits or in cash, and now I'm just not getting any interest. They keep cutting the rates, and they're going to go, we're going lower and lower. What do I do with my money? So what we've been, in context, we tried very much to play the Trump boom. So that was one of the things where we wanted to get lots of exposure to that. We've been trying to pull back on Australian shares as much as we can. We try to look at sort of there's 4 main asset classes we deal with, but we like to put Australian residential property in there just to contrast with what other people have. So for us, it's cash, which we're looking at very low returns or probably close to zero. Bonds, and when I say bonds, I'm talking about Australian high-quality government bonds. They're expensive, but we can see some scope for them to get even more expensive. So we don't want to have heaps of them, but there's still scope for that to play a part in your portfolio. The Australian residential property look very expensive. There's a little bit of upside you can see in the very short term, but there's lots of downside, and you sort of don't want to, and that's a very hard asset to trade. You want to buy properties and you're spending 5-10% of your money just to get into it. So you've lost 5 or 10% on stamp duties and transfers and all the other associated expenses. You don't want to be trading back out of that unless you can see a decent sort of runway. And so at the moment, it's very risky to say, I'll jump in today and try and ride another 5 or 10% over the next, as the Morrison 95% super guarantee, investor guarantee comes in. So we're trying to steer away from that. Australian shares. Now the big issue with Australian shares is not only are they expensive, but you're very leveraged to the Australian housing market, and you're also very leveraged to China, and they're 2 of those big risks we spoke about earlier. So for our part, that sort of leaves us with international shares, where they don't look as good as they have in the past, but you do have a protection from the falling Australian dollar. So if the Australian dollar falls 10%, your international investments rise by 10%. So what we're looking at is we can still see further downside for the Australian dollar. In terms of international shares, there are opportunities. They're not particularly cheap, but you can pick out different markets. We tend to find that we look in places like Europe for companies that aren't European generally, or companies that have got sort of global exposures, and so they're exposed to some of the growth you're seeing elsewhere without having to pay the prices that you pay in, say, the US, where markets are quite expensive. So for us, it's a mixture of trying to hold these balls, and we are holding quite high levels of cash just to try and we're switching in and out of these as they become cheaper or more expensive. But trying to find that safety and trying to keep that return, is important, and that's what we're trying to do for our customers, to try and find the safety and avoid some of those risks. But certainly at different times you want to be fearful or you want to be greedy, and now we're certainly closer to fearful than we are to greedy. Acknowledging though that markets do go up in the long term. So if you spend your whole life in cash, you'll never make much money. And by the time every light turns green and everyone tells you now's the time to invest, it's too late. So yeah.
Well, I really appreciate that rip through of all those very, very important themes and variations with regard to what's going on. I think what I'd love to do is perhaps have you back on a bit later and go into some more detail on 1 or 2 of those areas, because clearly we've touched a lot of ground today. But I really appreciate your time, and I think people on the DFA channel will really appreciate the fact that you've shared some of your insights with them. So thanks very much.
Yeah, thanks a lot, Martin. Yeah, I'd love to come back in and we'll talk through some of these in more detail.
Okay, great. Thanks for that. Talk to you soon then. Thanks. So there you have it, a really interesting overview of the various tides and cross currents that are affecting the economy. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.